Listen, folks, you thought we were done talking about massacres, but we're not, frankly. Unfortunately, we got another one lined up. Day 2 of obliteration. They're coming in hot for us, guys. They're coming in to eliminate everything right now. Just off of earnings. Beyond Meat. We'll talk about these earnings. My estimation here is that it's going to be again an issue with guidance. That's where we fall into a lot of these traps with these stocks lately, as guidance has not been what people are looking for. Now, this is a little bit different of an industry that wasn't necessarily impacted beneficially last year in a sense. So, guidance is, I think, should be less of an issue for this, but it is also one that's been known as fair to say, a hyper-growth company that people are looking at to still continue that trend. Let's take a look at these earnings, down 4% here. And already down 0.8 during the normal trading session. You look at the stock's performance this year so far, down 3%, relatively flat. Saw a big peak in February. Over the last year, though, down 8%, which is crazy because this is a stock, if you look 5 years out, saw a great run, really since it was founded in 2019. It's had some great runs and some terrible dips and some great runs and back to normal again. So, overall performance since May of 2019, not that incredible at 82% up, but not bad by all means. Just definitely one that I've been weary of for a while due to valuation concerns. But let's see if maybe we're making more sense now. Beyond Meat, quarter 2 non-GAAP EPS comes in at 31 cents, negative 31 cents, I should say. Company's never been profitable. Misses by 8 cents, and a GAAP EPS of negative 31 misses by 9 cents. So, miss on the profitability metrics. That would probably be part of your issue there with the stock. Revenue line looks pretty good. Can't lie to you, 149 million, up 31.8% year over year, is a beat by 8 million. So things are looking good in that aspect. Obviously, something you want to see. A good key aspect of this is going to be in terms of partnerships. You want to see what partnerships are working for them. Because from their aspect, they want to leverage themselves and leverage really their partners to help boost the name of the product and get it out there. So people might buy it more in a retail setting, which is one thing that they could really benefit from. Gross margin coming in at 31.7 versus a consensus of 30.9. Quarter 3 net revenues are expected to be in a range of 120 to 140 versus a consensus of 152.9. An increase of 27 to 47% year over year, respectively. Definitely less than was expected. So analysts are expecting around a 60% growth rate on this bad boy. They're guiding for a lot less. So that would be part of the issue, because median guidance here is around 20 million less than what the consensus was. Probably why you see a little bit of a massacre right now. We'll have to see if the earnings call might be able to save it. But let's take a look at this press release. And then I'll get into some of my thoughts on the stock. So, net revenue of 31.8, gross profit was $47.4 million. Not crazy. Net loss of a $19.7 million. It's not great, but it is definitely an improvement. It's an improvement, so we'll see that too. An adjusted EBITDA was a loss of $2.2 million. So even adjusted, it's still a loss, but definitely something I would consider concerning. We'll take a look at some of the finer details so you can see a comparison of it as well. So, let's see. Overall, they give you a breakdown here of by segment here in the U.S. U.S. net revenue saw a 4.8% change, which is kind of a concern there. You'd like to see a lot more than that, because this still should be a hyper-growth segment. It shouldn't have to be international that's necessarily carrying them, in my opinion. Up 187%, which is fantastic, but you don't want the U.S. growth rate to be slowing either. You saw actually retail sales, as I mentioned, dipped quite a bit, down 14.3% in the U.S. That, to me, is a big concern, because they need this segment to be successful, because they're not just going to be making crap tons of money off of the food service industry. There's many reasons why I think this. So there is a market, obviously, for these vegan alternatives and vegetarian alternatives, I should suppose. But there is a market for these. Now, the issue with it comes in the fact that these corporations are using Beyond Meat products because of it's cheaper for them right now to do that. If these corporations find that there's another service that provides it cheaper, or they can produce it in-house cheaper, if there's a big enough market, they certainly will. But as of now, they're using this because it's the number one brand that they can use. But if they find this is a big enough market, which frankly I don't think it is a big trend right now for sure, but I think you hear more about it than is what is actually being consumed. You hear a lot more about it than what you see in terms of consumption. So food service, great boost there. But again, I think this is a trend, and it's not one that's necessarily going to permanently stick around for necessarily Beyond Meat. There's going to be a lot of competitors getting into the game. And again, like I mentioned from the food service segment, I really believe part of the issue is going to be when these corporations, if they find a big enough market for this, they're going to be going with a cheaper option, or they're going to be making it in-house. So we'll see what that looks like. But again, that's my main point there. U.S. sales, it's a disappointment to me. If you're an investor in this company, you should be upset with that U.S. sales number because of that massive dip in retail. You got to know, again, they can blame it, and I know they will. They'll blame it off an incredible last year's sales, tough comparables. It shouldn't be that way. If they bought you out last year because you were the only product on the shelf, they should continue to want to buy that, right? If it was that great for them, which clearly they bought it out of necessity. That is where you get the concern. Necessity. I said that really weird, but that's where I get a concern there in my perspective. So you'd like to see a little bit better in that aspect. 6 months ending, U.S. retail sales only up 0.8, and net revenue is 7.5% up. I'd like to see better on that. I certainly would. International is a great segment for them, though. That's what you got to consider. But there does come a time in which that can't be what carries you forever, because U.S. should be still growing pretty well there, as they've been established there for a while and aren't seeming to grow. Let's take a look at the net loss here. We'd like to look at net loss, worth mentioning. So, what can I say? Things aren't looking great. $19.6 million compared to $10.2 million. Look, it got worse year over year. It did. As sales didn't increase by nearly that much, your net loss expanded by quite a bit more, nearly doubled, while you grew your revenue by 30%. That to me is a massive concern. And again, this net loss, frankly, this just comes from international expansion. So that's where you see this increase in net loss. So potentially when they get the market down, figure it out more, you can reduce this. But for right now, I really dislike that number. I really do. You don't want to see that going in the wrong direction. It shouldn't be. I don't like it. Let's look at the balance sheet, see what's going on with this company's balance sheet. So it's expanded quite a bit from 2020. Obviously, it was a very small balance sheet last year, but it has improved quite a bit because they've added a lot to it. $1.2 billion in current assets, $332 million the year prior, or 6 months prior, I should say. So quite some expansion even in the last 6 months, right around $900 million increase there. 1.4 in total assets in general versus 468 million. So again, a growth of right around almost exactly $1 billion there because of this gross growth in the cash position. Not a gross, it's growth. The only thing gross about this company is its net income line. Total current liabilities did see a decrease, but here's where you get the issue. Convertible senior notes saw a massive, massive growth because they had to raise capital because of the net loss issue because they're not profitable. So total liabilities in general, right at 1.1 billion compared to 11 million of 6 months ago even. So that is a massive, massive growth there just because of that convertible senior note line. And again, they do technically have the assets to pay that off, but it's barely skimming the surface. Stockholder equity saw a decrease over the last 6 months, 255 compared to 367. I don't like it. So let me just tell you what I feel about the stock. I don't like it. I don't think the stock's a buy right now. At a revenue last year of $406 million, trading at even a market cap after this of around $7 billion. I don't like it. Look, there's many reasons why I don't. And I mentioned this is going to be, if people see fit, this is going to be a hyper-competitive market. And I can't tell you that Beyond Meat's necessarily going to go ahead. I've heard a lot of people say great things about the product, tastes good. But again, this is a trend-based company right now. And it's not one that I necessarily see that is going to be a permanent standpoint for people. I really don't think it is. I think it is one of those trends that will come and go. You see it a lot. Keto diet it's one of those, veganism is, frankly, there will be people that stick to their guns that continue it. There'll be a lot of people that do it just because they want to feel trendy and do something that they think is cool, and then they'll go back after a couple months. So just keep that in mind. My main concern here is about competition, though. So that's my main argument against it. And I don't like that net loss line, right? This is a company that's just steeply increasing that net loss line. It's going to have to continue to raise capital, and it's going to get into a bad debt cycle. This is going to take a while for this thing to get out of that, but that's what I got for you today. Give me your opinions in the comments, and I hope you have a good day.